Good morning, traders. Today is June 5th. I'm doing this special update to alert you that the technology sector, NASDAQ and FANGs could potentially bounce approximately 7 to 10% over the next 5 to 15 days. It'll be very short-lived in my opinion, but we're getting a very solid bounce. As you can see here, I've marked it as a possible deep V bottom off the 618 retracement level. This could move a lot of traders into thinking that the bottom is in and the markets have established a very deep low. There's a lot of articles out there right now showing you that the NASDAQ is already wiped out quite a bit of valuation and could be a great opportunity. I believe this is a false narrative. I believe people are looking for a bottom and we're going to continue to potentially move lower. But in the meantime, we could see a solid 7 to 10% rally back up into this $1,000 level on this FANGs index, my custom FANGs index, which is available at mint.com. Every week I update these and give you my free research. So be aware. I'm going to point out the opportunities here, and then I'm going to point out the risks as well. Secondarily, let's look here at the U.S. to global market index. We've identified this 800 level on the global market index as a potential support zone, potentially down here in this $700 to $800 level is the ultimate bottom. I believe that this is a reactionary base showing a bit of a bounce here, and I believe that the U.S. markets are going to do the same thing. They could potentially move another 7-8% higher, maybe a little bit upward as a reactionary bounce, kind of like we had back over here. But I need you to be aware that overall the markets are still unwinding. The Fed is still going to try to stomp off inflation, and we have a broad unwinding of an asset bubble taking place. We're in a bearish trend. We're getting a potential for a nice little bounce here, but don't get married to that position. It's just a short-term bounce in the markets. Lastly, I want to point out the custom volatility index. This is showing us that the markets have entered a broader downtrend. You can see here since really June, July of last year, we peaked out at this level. This was a very strong rally phase, started to move into a new low here, lower highs, new low here, had a last little bout of an exhaustion phase near the end of the year, bit of a Christmas rally, and then we moved into a new lower low, lower high, lower low, lower high, and we're basing right in this area here, which is showing us that the markets are struggling to try to find support. We've found some support above this 6.0 level. 6.0 is really on this volatility index a very weak number, typically associated with weaker market trends and downtrending. But as long as it stays above this 6.0 level right now, it's trying to find support, trying to potentially bottom. And we could see a move back up into this 10-11 level, maybe even a little higher, before it weakens and I believe is going to move back lower and attempt to break downward. I think the next move in the market is going to be a washout extended low, but right now we have a bit of an upside potential here coming in. Okay, so let's come over here and take a look at the QQQ. This is a daily chart. I've highlighted Fibonacci levels from the peak in November all the way to the recent lows. And what we have, ladies and gentlemen, is a number of retracement areas here. So you can see that we have this longer term 618, we have a 5.0 level here, we have a 382 level here, and a 0.25 level here. Then we move from this recent peak. Let me try to get it right up at that peak. Close enough. And we have from this level, we have these levels of 618 right here, 5.0, 382, and 0.25. We've come up off of this 0.25 level and run into some resistance. This is the longer term cycle pattern or Fibonacci retracement level. I believe that we could see a move up into, from these levels, up into this 382 to 5.0 level up in this area. And then we can try to find support here, and then we can move back down and eventually cross downward. So this move here over the next possible 10 to 15 days is about a 7 to 8% rally potential in the NASDAQ. This gives you enough of an opportunity that you could trade this for a 4, 5, 6% move, or it could be a pretty good options trade. But understand that the reality is that we have very severe resistance in this area here and this area here. So we have an opportunity here to see it get above this level. It's really got to move above this 0.25 level and 382 level. So let's call it the 314, 315 level to really see some upward momentum. Right now, your current support level in the market for the QQQ is going to be right here at this 0.25 level. And this is going to tell us that the 303, roughly 25 or 30, is going to be critical support for the market. It gets below this level over the next week or so and tries to close this gap, we need to look at this as more continued downward bearish trending. If it stays in a support zone, which I believe is likely in this area, and attempts to rally, then we're looking at the 329, 330 level potentially, or moving all the way up to this level, which is the 336, 337 level. So you have some really good opportunity here for about an 8.5 to 10.5% rally in the NASDAQ if you play it smart. And we could see this stall out, turning into a bigger market downtrend. We just need to play it smart. This is going to suck in a lot of traders. It's going to get a lot of people thinking that the bottom is in, that we're seeing a longer term price base setting up. But I want you to be aware that longer term, we're really looking at extended price contraction. If we come back over here to this weekly chart and I show you longer term where we're at, the reality is that I believe the unwinding of the U.S. stock market super cycle bubble, which is taking place right here, really started back here in 2015, 16, 17. This is when the actual super cycle took place of a massive asset bubble. This tells us that we have some real resistance and support area down here in the 2015-16 range. And then we have this other secondary support level that I've been labeling near the lows of the COVID, which I will draw roughly right in here. And again, what I want you to point out at this area is this is the 2018 peak that took place when we had this brief rotation in the market, and then we had the rally out of it, and this was the Fed raising interest rates here, caused the markets to contract quite a bit into the December lows, and this of course presents some support back down here. And of course, we have support back down here at the COVID lows. But the reality is, as you can see from this channel I've drawn, we really need to get into this COVID midpoint area to try to find some support. And I'll draw it right here. So these are the areas that I'm expecting the markets to try to eventually bottom into. In other words, we're looking at a potential A, B, C, D up to here, E, move down to here, potentially maybe a little lower, then a bit of a relief move, which would essentially be a bit of a sideways consolidation before we see another A, B, C type correction to the downside. And this last move here will establish our support for the new base or bottom. And I'm going to highlight this as a consolidated base in the market. And this is following along with a broad-based pattern, which is a exhaustion phase peak. So we've had this massive rally from 2015-16. Come back here, try this again. Massive rally from 2015-16 all the way up. We've come down, we've established our peaking formation, which requires a flagging setup, which is what I believe we're about to start, is a flagging setup, which will rotate downward into a basing pattern off of this low and eventually break downward, try to find some support. And that's where we're at in the markets right now. So you've got a really good opportunity for an 8 to maybe 10 or 12% rally in the markets right now. Eventually, ladies and gentlemen, we're looking at this level right here to be our initial support. That would be in the 180, 190 to 200 range on the QQQ, possibly getting down to 175, 180. If it gets below that on an extended unwinding, then we're going down to these 2015-16 levels, which will put us down around 107, 108, 109 for some support. So there you go. The real opportunity right now is to stay protected, trade smaller amounts. Remember, in this trade, we do not want to be overly aggressive. What we're looking for right now is, I'm going to try to show it to you in clearer form. What we're looking for right now is a rally from these levels in a basing channel, kind of like this. And let me edit, change the style to a dash line, change it to a blue color. And what we're looking for is a rally in this type of a channel from basically here to here. So in this channel, these blue lines, look for a rally back up into this upper support zone right over here, possibly 10, 11, 12%. Then look for it to roll over and attempt to establish a new downward trend. Okay, that's your update for now. This is our opportunity. We may have, 3, 4, 5 weeks of a rally here, suckering a lot of people into it. You need to be aware that longer term, the pattern continues to play out. The excess phase peak pattern continues to play out almost perfectly. This move here should be establishing a new base. And what that's going to look like is what I've drawn. I'll try to draw it again so you can see it. What it should look like is a rally from this level up into this area, rolling over, breaking down below this low, establishing a new base at some point down here, trying to move along this base, and then eventually breaking downward. That's what we're looking at as ongoing price activity as we start to see this. Now, this could not, may not be exactly as I'm drawing it time-wise, but this shows us that we would be looking for potentially a breakdown in the market into Q3, Q4, which is where I think the real asset bubble decline is going to take place. That would mean that cryptos, the housing market, and quite a bit of other assets would be declining excessively. And then eventually come a move into December Q4 into Q4 2020 and early 2022, we should see the markets actually start to really establish a new base or bottom. Now, understand that for the entire move taking place here, gold and silver will likely continue to move higher and continue to try to base. Now, this has got a lot of charts, a lot of drawing on it. Let me get rid of some of this and try to explain to you that gold and silver will likely continue to reestablish support over the next 4 or 5 months, moving back up over here, possibly seeing some broader rotation as fear becomes more prominent in the market, eventually taking place with a rally up to the 22 to 2300 area, which would be a new high for gold, and that would put us up into here. This is where I expect to see some resistance, and this would be a measured move from here roughly to here. So if you understand a measured move from here to here, duplicate, And if you take a measured move from here to here and try to get to about that same area, you can see that this 2200 to 2300 area becomes the next target. So right in this area is where gold should move as the markets continue to play out. The next phase in gold will be a measured move even higher, and you can see I've already highlighted this in one of my other videos. So if we get a contraction and a base down in this area, a bit of rotation, the next measured move would put us up here 2600, and that again could be in late 2022, early 2023. We could be up in this area, starting a massive parabolic hypercycle, which is very difficult to explain, but gold in this mode would start a massive hyperbolic move, potentially moving up into the $36, $37, $4,500 area as fear and unwinding really take place. So there you go. There's your update. Stay informed and play the markets efficiently. Right now, if you take the trades, any trades, be very cautious about what you're doing. Protect your capital. Use smaller allocation levels to trade.